Hello, I'm Helen Hargreaves and I'm Head of Payroll Policy here at MBKB. It's my job to monitor all the legislation changes and what that means for payroll practitioners and to make sure that that's transferred into all our learning and training material. As we approach a new tax year, there's a lot of changes coming up and this session's going to pull everything together for you. You can see the agenda there. We will look first of all at the new rates, limits and thresholds that are going to be in force for the new tax year, the 2021-2022 tax year. There is some a new initiative which is NIC relief if you employ veterans, so I'll talk you through that. Look at some changes coming in for student loans and the national minimum wage. Statutory payments limits and thresholds for next year. Some changes to benefit in kind. We've talked a lot about off-payroll working, but there's just some clarification about what that penalty regime will be next year. A very, very recent change to public sector exit payments. This week, there was an extension to the gender pay gap reporting deadline announced, so I'll talk you through what that means. And then how MBKB are here to help you as you go through into the new tax year. In this next section, or the first section, there's going to be quite a few tables and they will be setting out what those new rates and thresholds are going to be for the new year. Don't worry, I am not going to start reading through all the numbers, but a copy of this webinar is going to be available on the Payroll website in the next few days. So I'll email you out a link so that you have everything for your reference, which is really what you need about with the actual numbers and the rates and the thresholds. So first of all, the income tax allowances, the personal allowance is the key one that affects most of us. So that one is going up to £12,570. The cap on the personal allowance limit before it starts to reduce is £100,000. And the married couples allowance, 9,125. I very much doubt that you've got very many people around now who've got the married couples allowance, but the marriage allowance, the amount that can be transferred from one half of the couple to someone who's not using up all the allowance, that's gone up to £1,260. We will be getting the P9X coding notices. They started to be issued on the 8th of February and they're going to carry on being issued on a rolling programme through until the 7th of March. So the first thing I need to say is make sure that you do go and access those P9 coding notices. They can be viewed online, but for your payroll team or everybody in your payroll team to be able to access the emails, it's important that HMRC holds the right email address. So please make sure that you go online and make sure that HMRC has the right email address for them to send you all the notices. HMRC tells us that when you're signing into that online account to get the P9X coding notices, you have to make sure that you select the correct year from the drop-down box. So make sure that you pick 21-22 tax year. If the P9 notices are still not showing, sign out and sign back into the account the following day, and that should allow the P9s to come in and be able to be viewed online. If you still get P9 notices issued through the post, paper P9Xs, they should be arriving with employers round about the 19th of March. So if you don't receive your paper notices in time for the first pay period on or after the 6th of April, you can request a duplicate. So you need to ring the employer helpline on 0300 200 3200. But You can only make a request for a duplicate in respect of a full employer scheme. It's not available just to get individual tax codes. You can view the rates and threshold changes either on this slide deck or on the Payroll website. There's a handout there with all the rates and limits on as well. Tax codes calculated for the 6th of April 2021 are going to include all these new changes. But I have to give you a health warning. Although we have been told what the tax rates and thresholds are, they are still subject to parliamentary approval. So there is a very, very, very outside chance that they could get changed from what we know. That happened once with the Scottish rates and limits a couple of years ago, where we were told what they were and then they didn't get parliamentary approval and they were changed. So that's just the health warning that goes with it, but it's very unusual. So the rates and bands for the rest of the UK. Now, the rest of the UK really these days is England and Northern Ireland, but because Wales has said that it will align with the rates and thresholds in England and Northern Ireland, for the time being, include our UK, include Wales in that as well. So we're just going to have a table for our UK and a table for Scotland, so they're the only two that are any different. So the band now for the basic rate has gone up to 37,700, so it's gone up £200. The other threshold, so the higher rate threshold is still 50,000, and you would pay the additional rate if you earned over 150,000. In Scotland, we still have the 5 different rates. I'm not going to start talking through all the numbers on there because I know that I'll just end up tripping over my tongue or something. So you can see them there, and you've got them for reference later on if you access the webinar slides or if you access the handbook out on the payroll website. NIC limits and thresholds. So the upper earnings limit has gone up to, we tend to work in monthlies, don't we? So that's gone up to 4189. And the upper secondary threshold, which happily is the same as the apprentice upper secondary threshold, that's gone up to 4189 as well. So it's tracking the upper earnings limit. The LEL, the one that is important to us all for so many things, that has stayed the same. So that's still £120 a week, which is nice and handy and good to remember. Earnings thresholds, the primary has gone up by £1 to £184 a week, and the secondary has also gone up by £1 to £170 a week. So when we look at the percentages, they have also remained the same. No changes across the board, so at least that's nice and easy to remember. If you're approaching your endpoint assessment or even for next year, at least you know that you don't have to get to grips with any changes in any rates because the percentages have remained the same. So one of the big changes that we've got coming in is that for employers who employ veterans, they will get some NIC relief on that. So from the 6th of April, employers can apply a 0 rate of secondary class 1 employer national insurance. Except that you can't really, because it applies, but you've still got to pay it in that first year. So for the first year, you must still pay the secondary national insurance contributions on eligible veterans, just as you would for anybody else. But then at the end of the tax year, then you can claim it back. mainly because it came in too quickly for them to build it into all the software, but be it the software that you use or HMRC software at their end. So whilst you will get that relief in this first year, you have to pay it and then claim it back at the end. From the next tax year, the 2022-23 tax year, employers will be able to claim that relief in real time. The hope is that the policy will provide employers with a relief of up to a maximum of £5,000 for each qualifying veteran hired. To define a veteran, it's anybody who has served at least one day in the regular armed forces. And this relief is available to all employers who hire veterans, irrespective of when they left the armed forces, as long as this is their first civilian employment since they left. So you would have to get some evidence that that was the case. If they left quite a while ago, then you would have to get evidence that haven't had another job in the meantime. And then national insurance relief is available up to the upper secondary threshold. So if they're high earners and earn above the UST, you would still get relief on their earnings up to the UST, but then you would have to pay full national insurance on anything above that secondary threshold. It's available for the 12 months from when they started that first employment after leaving the forces. Now, if the worker does not stay with the same employer for 12 months and they move to a different one, that 12-month period still continues through. So the 12 months starts on the day that they start employment with their first employer after the forces, and then it keeps running for 12 months after that. If there are different employers within that 12 months, then they can all claim. But the clock doesn't stop and start again with a new employer. Once it's started, that clock keeps ticking. Okay. Student loans now. Over the next few weeks, it's really possible that you are going to receive an unusually high number of SL1 start notices. Now, we always get a bulk issue of SL1 notices at this time of year because people start repaying their student loans in the start of the tax year after they've finished their studies. So we get a lot at this time of year anyway for those that finished studying last year and are now in employment and off they go. But this year you are likely to get even more SL1s than normal. Why? Well, because you will see on this table, there's a new kid on the block there. There's a plan for loan. So let's just have a quick look through the ones that we're familiar with. The plan 1 threshold has gone up about £500. So it's gone up to 19,895. The plan 2 threshold has gone up to 27,295. Both of those are payable at 9%. The post-grad loan, no change on that. The threshold's still 21,000. But we've got this plan 4 loan that applies to Scottish loans. So Scottish borrowers who drew down a Scottish student loan from the Student Award Agency for Scotland, they're currently repaying their loans under the Plan 1.
But all students who borrowed from the Student Award Agency for Scotland and are currently on Plan 1 will all get moved across to Plan 4 from 6th of April. The Plan 4 threshold is going to be £25,000 and deductions will be calculated at 9% of earnings above the Plan 4 threshold. So that means that you'll get SL1 start notices for all those who took out a Scottish loan and are currently repaying it under Plan 1. They're all going to get moved across to Plan 4. And remember, this is for employees who took out a student loan in Scotland. Not necessarily that they're still living in Scotland now, because people have a habit of moving. And so they might well be working for you. They might well be living in England now. And you might be unaware that their loan was taken out in Scotland. So you need to expect additional SAL1 notices for that reason. But what you might also get more of are more GNS notices, the general notification messages from HMRC. You'll be getting those reminding you not to deduct student loans repayments from anyone who is subject to either the off-payroll working rules or anyone who's on a pensions payroll rather than a salary payroll, because you don't take student loan deductions from them.
National minimum wage. So we do have changes to the national minimum wage rates. As always, they rise on the 1st of April. But you will see here that we've got quite a major change to the national living wage, because currently the national living wage applies to people aged 25 and over, but from the 1st of April, it will apply to people aged 23 and over. So you need to make sure that you have an assessment of your workers, all those who are 23 or 24, who you weren't expecting to apply the national living wage to, because you're going to have to. Hopefully your payroll software will identify these people for you, but make sure that you have plans in place to check that everybody who is eligible is paid the national living wage, to make sure that you don't fall foul of any regulations there. National minimum wage is one of the few compliance areas that is really, really growing. HMRC is really focusing its gaze at national minimum wage, and just recently the naming and shaming started again for employers who had not been compliant, and there were some big names in there. So from BEIS's list, that's the Department for Business, Energy and Industrial Strategy, they list common errors, the things that people fall foul of. So just to give you a heads up, making deductions from wages to pay for uniforms, failing to account for overtime hours correctly, failing to pay workers for travel between jobs, and this is a huge one now for care workers as they're moving from client to client, especially in these times. Paying apprentice rates to workers that aren't apprentices, using tips from customers to top up workers' pay. Now, there'll be less of that at the moment because tips mainly come from the hospitality industry, and of course that one has not had much activity this year. But as we start to open up, if you're in that industry, then this is one to focus your mind back on, because we'll have got out of the habit of what we're supposed to be doing with that over the last year or so. And making deductions from wages to pay for the workers' Christmas party. That always seems like a cheeky one. Here's your Christmas party, but you've got to pay for it. Statutory payments next. No major changes here. It's just an annual uprise of the rates. So again, you will get a copy of these slides so that you will know, but the SSP £96.35 and all the parental leave ones £151.97. You'll be glad to know I'm not going to read that one out. So that's the SSP daily rates. That's just a reference table for you, because it's always useful to know, depending on how many days somebody works, is how much you pay them a day when they're off on SSP. Benefits in kind, just slotting this one in simply because it's timely. It's not a change for a new tax year, because the advisory fuel rates go up every 3, or are reviewed at least every 3 months. But we just got told yesterday what the advisory fuel rates are going to be from Monday. So here they are. The previous rates are in brackets and the new rates are not in brackets. So you can see that we've had a change to the petrol engines, 1400 to 2000 and over 2 litres, and the same for diesel between 1600 and less, that's gone up, and 1600 to 2 litres, that has also gone up by a penny. So optional remuneration arrangements. If you are in, or your business operates a salary sacrifice arrangement, which is also known as OPRA or optional remuneration, and you started the arrangement before 6th of April 2017, then you'll have benefited from the transitional rules that were brought in to help manage the transfer from the old to the new arrangements. However, all good things come to an end, and this transition period ends at midnight on the 5th of April. So a refresh of the OPRA rules under very simple terms: an employee who gives up cash pay for a perk, so it's normally a company car, they're taxed on the higher of the cash given up or the normal taxable benefit of that perk. So for example, an employee gives up £5,000 to get a company car. That company car would normally have a taxable benefit of £4,000, but the employee will still be taxed on the higher amount. So they will be taxed on the £5,000, the cash that they've given up, not on the £4,000 taxable benefit of the car. There have been some exceptions to that, and those exceptions remain. So pensions contributions and advice are not affected by the transitional arrangements, nor are employer supported childcare, so that's your childcare vouchers, the cycle to work scheme, or ultra low emission vehicles. They're still okay, but if there's anything else that you are giving through OPRA, then you need to start looking again at the arrangements. Yes, there's a question come through on the chat. Those are the only exceptions. If you think about it, the government gives incentives for the things it wants us to do. So it wants us to pay a pension, to make pension contributions. It wants us to have childcare so that we come back to work. It wants us to cycle to work so that it's better for the environment, and the same thing for the ultra low emission vehicles. So the things that it wants us to carry on doing, it will offer the incentive for. Everything else, it doesn't have an incentive for. So if you've got any arrangements that are other than these 4, then you need to start making sure that any transitional arrangements are moved across to the new arrangements. Yes, we've got another question. Payment for critical illness cover, it's not one of the exceptions, so it has to be under the new arrangements. In fact, if it's come in after the April 2017, then it would be under the new arrangements anyway. The transitional arrangement only goes for those arrangements that were in place before April 2017, and it's to give people chance to update these arrangements as we move through. But this year is that cut-off, and everything now has to be taxed under the new arrangements. So what are those arrangements? When a benefit is chosen, the chargeable value is the higher of the cash foregone or the cash allowance not taken, or the benefit value. So when people have a choice of something, you can either have the money or the benefit, which costs most, and it's that higher amount that they're taxed on. It doesn't apply to car allowances where there's no car option, because the clues in the title, it's an optional arrangement. People are given a choice. So if they're not given a choice between a car allowance or a car option, and they are just given a car allowance, then they're just given the money. So you would tax it as money, because that's exactly what it is. So under those transitional arrangements, for contracts that were in place before April 2017, there were two different sets of transitional arrangements. So the arrangements for cars, vans, accommodation and school fees, they were protected until this April. So those are the ones that you've got to start focusing your mind on. The arrangements for every other benefit ended in April 2018. So they were always moved on onto the new plan. However, if that contract had changed or updated or needed renewing before this April, then at that time of renewal or change, then they would go on to the new rules at that point. So it's only those who've had the benefit before April 2017 and when nothing has changed since. Those are the ones that you now need to start looking at. There are implications for employers and employees. If you're in the payroll department and you have employees with benefits under these old transitional arrangements, then you need to start preparing new arrangements that need to start on the 6th of April. It's undoubtedly going to lead to some employees paying more tax. So you also need to start thinking about how best to communicate that to them, to prepare them for it. Now, the cycle to work is one of those benefits that still retains that advantage of the tax relief, but the cycle to work schemes benefit from that tax relief on the provision that the bikes and the safety equipment are provided as long as they are used mainly for qualifying journeys, and a qualifying journey is essentially the commute to work or back. So with lockdown and with COVID, the Treasury has realised that many employees are now working from home, and they might have this cycle sitting there in the cupboard under the stairs, and the only time they use it is when people go out for exercise, because they're not commuting to work. And because the time that it's used is for leisure or exercise reasons rather than for commuting, that means that, strictly speaking, that benefit no longer meets that tax exemption requirement. So it's not mainly used for commuting. So really, it should be liable for an income tax benefit in kind charge. That one would be incredibly harsh if they were going to impose that, because it's nobody's fault. So to prevent that, the government is temporarily removing that qualifying journeys condition for employees. So if someone entered into a cycle to work scheme before the 20th of December 2020, well then that condition that they use the bike mainly for commuting is suspended, and it's suspended until April 2022. So anybody who had a bike before December, that's fine, they're not going to get liable to that tax charge. Anyone who joined the cycle to work scheme from the 21st of December 2020 onwards, i.e. we were already in lockdown and you already knew that you couldn't commute, then they will still need to meet all the normal conditions of the exemption. Off-payroll working penalties. Now, we've talked enough about off-payroll working rules themselves, so this is not an update on off-payroll working rules. But this is about what happens if you get it wrong. So the government said this time last year, they said that when the rules came in, they would take a light touch for penalties in the first year, i.e. if people were trying but did the best and just misunderstood the rules or whatever, and accidentally got it wrong, then HMRC would not issue a penalty. We've had guidance that's just come out, and that now confirms this position. So The guidance says that they won't issue any penalties for any inaccuracies in the first 12 months unless they're related to deliberate non-compliance. So that happens regardless of when those inaccuracies are identified. What the government has said is that you do have to assess the status of the worker, and if you don't assess the worker's status, then you will get a fine. But if you assess the status of the worker and accidentally get it wrong, then you won't get a penalty as long as you've not done it for any deliberate tax avoidance reasons. So the key here is you will be fined if you don't do it, but you won't be fined if you do it and you do it wrong. And that's in that first 12 months because they want to help and support people to get it right. For those of you that heard the MBKB webinar last month, that was all about the topic of off-payroll working, and it is available on the Payroll website, and there is also full guidance on gov.uk as well. Public sector exit payments. Now, this was interesting because in November 2020, so 3 months ago, the government introduced a cap on exit payments for people who were leaving the public sector. So you couldn't pay more than £95,000. Only 3 months later, the government has done a U-turn. And what they have said is that there were unintended consequences of bringing in this cap. So they are revoking the cap, and they're revoking the cap immediately. So if you have issued any exit payments between the 4th of November when the cap came in and the 12th of February when the government changed its minds, if the cap applied, so you capped it at £95,000 and it would have been higher than that, then you can reapply that cap, you can recalculate the payment, and you can pay the extra payment. We have got a question about OPRA. I'll come back to that question at the end if that's okay, because we've moved off that one, so I'll just come back to that topic later. So we'll stick with the exit payment caps for now. So if you have any of those exit payments that apply in that case, then you can recalculate them. The regulations haven't yet been revoked because that's a legal process that takes some time, but they have been suspended while that revocation goes on in the background. So, extension to gender pay gap reporting deadline. Again, this is something that's only just come out in the past week. Due to the impact of COVID-19, the Equality and Human Rights Commission have announced that employers now have until the 5th of October to report the gender pay gap information for the 2021 reporting year. So that is the one which uses a snapshot date of last year. So for the public sector, the snapshot date is the 31st of March 2020. For the private sector, it's the 5th of April 2020. Though you get 12 months in which to report your gender pay gap information, so they would have been due for reporting by the 30th of March and the 4th of April respectively this year. And with COVID going on, with people not being able to get into the offices, with information being there that they can't get hold of, then they've given a 6-month extension. Now, we do have a question about that. The question is gender pay gap reporting done only through HMRC website directly, or can it be similarly as FPS from the payroll system? The gender pay gap information is not reported to HMRC. It's not covered by HMRC because it's nothing to do with the tax or anything. So you do this separately. It's covered by the Equality and Human Rights Commission, and you upload it to a completely separate website. So the people that are responsible for doing it will already know, or should already know, how to do that, because there is a separate portal for that. You would go through the government gateway, but there's a separate portal, so it's not HMRC. And as well as doing that, they have to, or they are encouraged to produce a report which explains what those results are, and there also has to be a declaration that declares that the figures are true and accurate. So completely separate from HMRC and from your FPS. Just as a reminder about gender pay gap reporting, because we know that this is something that comes up a lot in the apprentices endpoint assessment. These are the categories that you have to declare under the gender pay reporting. Again, I'm not going to talk through them because this isn't a tutorial session about gender pay gap reporting, but at least you know that that everything's here and you can come back and have a look. The biggest issue is whether there are 6 or 7 categories, and there used to be 7 categories, and now it has dropped down to 6, mainly because category 4 used to be the percentage of men receiving bonus pay and the percentage of women receiving bonus pay, so that it was into 2. Now they've merged it into 1. So if you get a question on that in your endpoint assessment, then you know what the answer is. So we're here to help. We have some new payroll training courses. We have got P11D training course because the deadline will be approaching. It may seem ages away, 4 or 5 months away, but that will come so quickly because you've got to get rid of end of year first. Already you can see that events are selling out, and the reason why they're selling out, they are online events. So you might think, well, you can get as many as you like on there. No, because what we do with our training courses is tailor them to you. So we need to limit the number because we say ahead of time, have you got any specific issues that you want to talk about in that training course? Have you got any particular benefits? Do you have to pay chauffeurs or something like that, where there's a benefit that wouldn't be covered under the normal generic training course? Then we can make sure that we include it. So for that reason, we have to limit the numbers, because otherwise we could be inundated with requests to bespoke it. So you can see there the training course. We've got P11Ds, and then we've got a payroll legislation update. So I've given you a legislation update today that's lasted 3/4 of an hour. The training course is a whole day event because it talks you through all legislation, not just the changes, but the whole of the legislation, what you are required to do in all different circumstances, and that is usually a training course that we recommend that you go on once a year so that you can refresh your memory of all the legislation that we've got and what exactly it means for payroll. So if that is something that interests you, there's a link there on that slide, and you can go in and have a look and see more information about the training courses. We have, right, okay, we're going back to the gender pay gap. We've got a question that says, what do you mean by produce report? To produce report and keep if they are being inspected, or to produce the report and submit also? Gender pay gap reporting, there is a set format to do it. So you are reporting the figures. The report says that you have to, let's just go back to that screen. You have to report if you have more than 250 employees. So if you don't have more than 250 employees, you can sit back and breathe a huge sigh of relief. If you do have more than 250 employees, then there is a requirement on these companies to report their figures in all these categories, so that you have to on the snapshot date. So for public sector, that is the 31st of March, and for the private sector, it's the 5th of April. Every year you have to do a snapshot date of on that date and look at the hourly rate for all the employees and then break it down. So then you have to look at the percentage of men and women in each hourly pay quarter, the average gender pay gap, median gender pay gap. So the difference is the mean is the average, the median is that middle point. So that can be very different from the average. How many men receive a bonus, how many women receive a bonus, what's the pay gap of that bonus, and the middle point of the gap of the bonus pay. And there is a report, there's a structure that you have to complete. It wouldn't be a payroll administrator's job to do it. Very often falls within HR, but whoever does it has to get the figures to know how to do the sums. And then they are encouraged, and that is usually by an HR director or even the CEO, they are encouraged to produce an explanation of why their figures are the way they are. If I give you an example of a football club, a Premier League club, its players, assuming it's one without a women's team, its players are going to be males and they are going to earn squillions. That's a technical term, they're squillions. Whereas the people who do the cleaning, work on reception, man the canteen or whatever, are possibly more likely to be female. So there is going to be a huge gap between the amount that the men earn and the amount that the women earn. But the chief executive or whoever can do a report that says, actually, there's a reason for this. You might get the same with the fire service, for example, because predominantly firefighters are men. Not all, but mainly. And the people back at the station house could well be women. So you might well find that the people who go fight the fire earn more than those who look after the firehouse. So there could well be a genuine reason why men earn more than women. So that explanation is also accompanying the report. What I would suggest you do is that you Google gender pay gap reports, and then you can look at the website. They're available to anybody to look, and you can look at some of the big names that have filed theirs, because they will also say in the report what they are doing to close that gap. Very often, or because we've been doing this for a few years now, the reports may well say, actually, after the first time we did it, we've now taken action to close the gap, and this year's figures show that the gap is closing. And that's what that report is. So I suggest that you Google it and go and have a look, and then you can see for yourself exactly how that comes about. So where were we? We were on with the support that we provide. As you know, I provide you with a monthly newsletter that gives everything that you need to know about that current month. And then we provide these monthly updates. Tends to be alternate. So 1 month we'll specialise on a particular topic, and then one will be a general update like today. If you don't get the newsletters, check your spam folder, because if you are on our mailing list, then you should get it. If this is your first update and you're not part of the MBKB family yet, then get in touch and you can get onto our mailing list there. So the email addresses are on the screen. Right, any questions? I know that we've got a question that we missed earlier on, so let me go back to that one. Opera arrangements. If you get a flexible balance additional to basic salary and the car allowance is paid as part of the flex payment, is that subject to optional arrangements, please? what we have to do is, I'm not going to say based on this information here because we've not got enough information, but what I would be looking at is, does somebody have an option between taking some cash or taking a benefit? And if they have an option of taking cash or taking a benefit, then they are taxed on the higher of the two. If they are given a car allowance and any other allowances, they're actually given the cash and they're not given an alternative, then the tax, that's cash and the taxed as cash. And that is the key element there. What have they taken? What have they been offered? Now, if that is something that you want to explore in more detail and you're a member of payroll, then email that payroll support at MBKB or give me a ring, and then we can start to talk in more detail about your particular circumstances. But here on this webinar, I'll just leave it as, are they given a choice, or is it just that they're given the cash? And if it's anything else, then we'll take that forward. And that looks like it's a good answer because someone said that they're going to give me a call. So no, everybody else know, if you are a member of Payroll and the MBKB family, then you can give me a call at any time and we can talk through what issues you've got. Do we have any more questions? It's looking like not. I'm giving people chance to get the typing fingers going, but it looks like that's it. So we will bring this session to an end now. I would like to thank you all for your time. Hope that it was very useful for you. As I've said, I will email you out a copy of the slides once they are on the website. Okay, with that then, I will ask you all to have a marvellous rest of the day. Have a great weekend and hope to see you next time. Bye-bye.